When you deposit a paycheck, you assume that money sits in the bank waiting for you. When a bank approves a car loan, you assume they're lending someone else's deposit. Both assumptions are wrong. Banks don't move money around. They create it the moment they approve a loan, which is why a single rumor can erase a century-old institution in 48 hours. Most of us imagine banks as warehouses. You deposit $100, it sits in a vault with your name on it, and the bank occasionally lends some of it out. That's not even close. Since the 1960s, the banking system has operated on a principle that sounds like science fiction. Lending creates money that didn't exist seconds before, and that new money becomes someone's real deposit, which the bank can lend again. This isn't a glitch. It's the design. Central banks permit it because it lets a small amount of physical currency support an economy worth trillions, but it also means the entire system runs on a shared belief that everyone won't ask for their money at the same time. The technical term is fractional reserve banking, but that phrase hides the weirdness. Here's what it actually means. When you deposit $1,000, the bank is required to hold a fraction of it, say 10% or $100, as a reserve. That reserve can be physical cash in a vault or a balance held at the central bank. The other $900, the bank can lend it out. Except they don't lend your specific $900 because money isn't parceled out with name tags. Instead, they make a loan to someone else, and the moment that loan is approved, the bank creates a new deposit in the borrower's account. That deposit is new money. It didn't come from your deposit. It came from the bank's ledger, from their authority to expand the money supply by saying yes to a loan. Here's how it works in practice. You walk into a bank and apply for a $10,000 car loan. The bank checks your credit, decides you're good for it, and approves the loan. At that instant, the bank creates a $10,000 deposit in your account. They didn't withdraw it from anyone else's account. They didn't transfer it from a pile of reserves. They typed it into their system. Your account balance increases by $10,000, and you now owe the bank $10,000 plus interest. Both sides of that ledger are real. You can spend the $10,000 immediately. The debt is legally enforceable. The bank has simultaneously created an asset, your loan obligation, and a liability, the deposit they just credited to you. Now you spend that $10,000 buying a car. The seller deposits your payment into their bank, maybe the same bank, maybe a different one. Either way, that $10,000 is now someone else's deposit. If it lands at a different bank, that bank receives the funds and must hold 10% as reserves, $1,000. The remaining $9,000 is available to lend. So they approve a small business loan for $9,000. Instantly, another deposit appears in the business owner's account, $9,000 that didn't exist a moment ago. The business owner spends it on equipment, and the equipment supplier deposits it. Their bank holds $900 in reserve and lends out $8,100. The cycle continues. This is money multiplication. A single $10,000 loan can generate $90,000 in total deposits across the banking system if the reserve requirement is 10%. Each loan creates a deposit. Each deposit supports another loan. The math is straightforward. Divide the original amount by the reserve ratio. 10,000 divided by 0.1 equals 100,000 in potential deposit expansion. In reality, the multiplier is smaller because people hold some cash, and banks sometimes hold excess reserves, but the principle holds. Lending doesn't transfer money, it manufactures it. The confusing part is that this newly created money is indistinguishable from money that came from your paycheck. When the business owner's supplier checks their balance, they see $9,000. They don't see a footnote saying this is loan-generated deposit, third generation. It spends the same. It's insured by the FDIC up to the limit. For all practical purposes, it is money. And it is money, just money created by a private bank approving a loan, not by a government printing bills. 3 big misconceptions trip people up here. First, many believe banks lend out deposits. The causality runs the opposite direction. Loans create deposits. A bank doesn't wait to gather deposits before making loans. They make loans based on their capital reserves and regulatory limits, and the deposits appear as a result. Second, people think reserves are a safety cushion to pay back depositors. Reserves are an operational requirement to settle transactions between banks and to satisfy regulatory ratios. If every depositor demands their money, reserves won't come close to covering it. Most of the money is in loans, illiquid assets that can't be converted to cash instantly. Third, the phrase printing money makes people imagine physical currency. Most money never touches paper. It's numbers in a database, but those numbers are enforceable legal claims. This system works beautifully until confidence cracks. Imagine a bank has $1 billion in deposits and holds $100 million in reserves. The other $900 million is out in loans, mortgages, business lines of credit, car loans. Those loans are assets to the bank, but they can't be recalled instantly. A mortgage might not mature for 20 years. If a rumor spreads that the bank is in trouble, maybe they made bad loans, maybe they're exposed to a failing sector, depositors panic. They want their money now. The first 100 customers withdraw $100 million, and the bank hands over its reserves. Customer 101 asks for their money, and the bank has nothing liquid to give. They can try to sell loans to other banks, but in a panic, nobody's buying. They can try to borrow from other institutions, but if the rumor is widespread, no one will lend. The bank fails, not because its loans were worthless, but because it couldn't convert them to cash fast enough to meet withdrawal demands. That's a bank run. Silicon Valley Bank collapsed in 2023 this way. Their deposits surged during the tech boom, and they parked the money in long-term government bonds, which are safe but lose value when interest rates rise. When rates spiked, the bonds were worth less. Depositors, many of them startups who talk to each other, heard the bank might be shaky. $42 billion fled in a single day. The bank couldn't sell its bonds without massive losses, couldn't cover the withdrawals, and regulators shut it down within hours. The loans and bonds weren't bad. The timing was impossible. Bank runs expose the fundamental fragility. The system depends on most depositors never asking for their money at once. If they do, the math doesn't work. Banks can't keep enough reserves to satisfy everyone because the whole point of fractional reserve banking is to lend out most of what's deposited. Deposit insurance, introduced after the Great Depression, mitigates this by promising the government will cover deposits up to $250,000. That reassurance stops most panics before they start. Central banks also act as lenders of last resort, offering emergency loans to banks facing sudden withdrawals. But those safeguards only work if the panic is isolated. If confidence collapses across the system, even central banks can't manufacture liquidity fast enough. So here's the summary. Banks create money by approving loans. That money becomes a real deposit, which the bank can lend again, multiplying the original amount through the system. It's not fraud. It's the engine that allows a modern economy to function without requiring a vault full of gold behind every transaction. But it only works if everyone believes their deposits are safe and available. The moment that belief falters, the illusion shatters, and a bank with perfectly good loans can vanish in a weekend. The money is real, but the system runs on trust. And trust is the one thing a balance sheet can't manufacture.